Chapter 9 deals with accounts receivables. Accounts receivables are amounts due from customers from credit sales. We did introduce sales on credit in Chapter 5. So when we sell merchandise on credit, we have two entries, and one of those entries deal with specifically the credit sale. And we debited accounts receivable, and we credited sales. One little piece they add to this is that our accounts receivable subsidiary ledger, where we would also indicate the company name. And what we want to do is keep track of all the sales for our individual companies that we have on credit. So that's in our accounts receivable subsidiary ledger. And then you have, of course, the overall total account receivable ledger. And then when you collect it, you would debit cash and then credit the account receivable, indicating that company name. So they also indicate what happens when we have credit card sales. So we have credit card sales, meaning when we allow our customers use credit cards in our store. They're going to either be treated as an account receivable or as a cash sale, one of the two. If it's a credit card where you get immediate deposit of cash, so a lot of times your major credit cards, Visa, MasterCard, when you use that credit card machine and it's hooked up to your computers and all that, when those sales go through, you get that immediate deposit of cash, of course less the fee that they charge you. So in that instance, we're going to treat that as a cash sale. If it's a reimbursement that we get later, a lot of times like in the form of an American Express, they don't do that immediate deposit. They batch those credit card sales and then they make a deposit later. We're going to treat that one as a account receivable. So if it's a Visa, MasterCard, one of those credit cards where you get that immediate deposit of cash, so let's say that you have $20,000 in sales. You're going to get some cash, obviously, immediately deposited in your bank account. They're going to take out their fee, and we're going to call it a credit card expense of accepting credit cards, and then we have our sales. So if we had $20,000 in sales, and let's say they charge you 1%, or in this instance $1,000 fee on those, so they would only deposit in our account $19,000. And so they take out that expense before they deposit that cash in our account. You still would have that second entry of your merchandise entry, but I'm just focusing on the sale side of the entry. If it is a situation where we're going to treat it as an account receivable because we don't get it immediately, our entry would be, we would debit accounts receivable instead of cash. We would still debit our credit card expense, and we would still credit sales. So let's say in this instance we had $5,000 in sales. They took out a $200 fee, and that's normally a percentage of sales is what the fee is. And then we would debit accounts receivable for $4,800. Then let's say later, when you actually receive it, it will just be a simply debit to cash and a credit to the account receivable for the $4,800. So that would be your entry. So those are covered in the first couple of pages of the chapter. And then they move on to how do we value our accounts receivables. We could have $1 million of accounts receivables on the books, but are we going to collect all that $1 million? So what is our value of accounts receivable? So we have to look at writing off accounts receivables that aren't going to be collected, or what we consider bad debts. I mean, our goal, of course, is collect 100%, but we know we have some uncollectible amounts, accounts receivable. So bad debts are uncollectibles. So we want to look at actually writing those off. And there's two methods in writing them off. The first method we want to look at is the direct write-off method. And in the direct write-off method, as we identify accounts that we deem that are not going to be uncollectible after we, exhausted our means of collecting them, we write them off. We directly write them off as we identify them. And so the entry for that would be a debit to bad debt expense, and we would credit accounts receivable, whatever that account is, because we're writing it off. Let's say Gap, that's the company or the account. So we would debit bad debt expense, we would credit accounts receivable. And so, because when we originally recorded it, we debited accounts receivable, we credited sales. Now we're determining that it's not going to be collected, so we want to expense it. We want to debit bad debt expense and credit accounts receivable. That is our direct write-off method, where we directly write it off. When we identify it, we write it off. We identify this account, we write it off at whatever time that may be. And doing so, they covered this a little bit in your chapter. Well, what happens is after we write off a bad debt, we recover it. What do we do? After we've written it off and then they pay? So what do we do? So there's two entries that we have to do. First, we have to re-establish the account receivable, because remember, we wrote it off our books. And then basically we reverse the entry that we had originally did. So we had originally debited bad debt expense and credited accounts receivable. And so now we recovered it, so we want to debit accounts receivable and credit bad debt expense. Now the account receivable is back on our books, and so then we show that we collected it by debiting cash and crediting the account receivable. So that's what you would do if you've written off an account and then later you collected it. Okay? And so the last little part of this one I want to cover is that when we are looking at the direct write-off method, remember I said we write off an account when we identify it. So let's say that I had an account receivable or sales that occurred on account receivable. Let's say it happened in November of 15. So when I do my books for 2015, I have that account receivable on the books and the sales is on the books. So the income was reported in 2015. And let's say it's not till 2016 that I determine that it's bad and therefore I write it off. So the problem with that is that the expense occurred in 2016 and the sales occurred in 2015. And so if you remember our matching principle, the matching principle tells us that our income or our revenues and all the expenses related to those revenues should be reported in the same year. So there's a possibility that the direct write-off method does not meet the matching principle, because my revenue could occur in 2015 and the expense or the bad debt expense could occur in 2016. So that would be an issue in that it may not meet the matching principle, the direct write-off method. And so that's a problem. But there's another principle called the materiality principle that says that amounts that are, hold on, let me back up, sorry about that. Basically, the materiality principle tells us that if the amount is considered immaterial, it is so hard writing on this computer screen. I appreciate you putting up with my bad handwriting. If it's immaterial, then we are allowed to use the direct write-off method. So meaning that if we're not talking about huge amounts and we're only writing off small amounts in relationship to our sales and those amounts are immaterial, then it's okay to go ahead and use the direct write-off method. And that's the only way that we can use the direct write-off method, because it doesn't always meet the matching principle, so it fails that test. But because of the materiality constraint or principle, it tells us that we can go ahead and use this amount if the amounts that we're writing off are immaterial.